Two men walk out of the same dealership on the same day. Same neighborhood, same job, same $52,000 salary. One of them is about to make a decision that will quietly cost him $47,000 over the next 6 years. He doesn't know that yet. He's too busy smiling at the new car in the parking lot. Meet Ollie. He's 27, works in logistics coordination for a mid-sized company in the city. He earns $52,000 a year. Before tax, that's about $4,333 a month. After tax, deductions, health insurance, he takes home roughly $3,100. He's not struggling, but he's not comfortable either. He's somewhere in the middle, which is exactly where most of us spend most of our lives. Ollie has a car, a 2014 sedan with 130,000 miles on it. It's not glamorous, but it runs. His mechanic told him recently, though, that the transmission is starting to show wear. Could last another year, could fail next month. So Ollie does what most people do when they feel a financial decision creeping toward them. He starts looking. Not because he planned to, not because he sat down with a spreadsheet and mapped out his budget, but because the fear of being stuck on the side of a highway is a powerful motivator, and a dealership is one of the most psychologically engineered environments ever designed for someone in exactly that state of mind. He's not impulsive, he's not reckless, he's just a person under mild pressure with no formal financial training walking into a building full of people who do this for a living. This is where the story really starts. Ollie finds a 2021 certified pre-owned sedan, 38,000 miles, clean history report. It looks solid, reliable, exactly what he needs. The sticker price is $24,500. He doesn't have $24,500 in savings. He has about $4,800, money he's been setting aside slowly over 2 years for a down payment, for emergencies, for something. So he's financing, which is completely normal. Most people do. Here's what happens at the finance office, and this is the part nobody talks about clearly enough. Ollie sits down across from the finance manager, not the salesperson. This is a different person, a specialist, and this person's entire role is to present financing options in a way that maximizes the dealership's profit while keeping Ollie comfortable enough to sign. The finance manager shows Ollie 3 options. Option A, 48-month loan at 7.9% APR. Option B, 60-month loan at 8.4% APR. Option C, 72-month loan at 9.1% APR. And then, and this is the move, he doesn't lead with the total cost of each option. He leads with the monthly payment. Option A is $597 a month. Option B is $496. Option C is $432. Ollie looks at those numbers and immediately thinks about his $3,100 take-home. He mentally does the math. $432 a month. That's manageable. That's roughly 14% of his income. He can do that. He picks option C. He doesn't realize this yet, but that monthly payment comparison just cost him thousands of dollars. Let's actually run the numbers on what Ollie just agreed to. The car is $24,500. He puts down $3,000, keeping $1,800 as an emergency cushion, so he's financing $21,500. At 9.1% APR over 72 months, monthly payment $432. Total paid over the loan $31,104. Total interest paid $9,604. $9,600. I'm interested, on a car that cost $24,500. Now, let's compare that to option A, the one that felt too expensive at $597 a month. Financing the same $21,500 at 7.9% over 48 months, monthly payment $523, total paid $25,104. Total interest paid $3,604. The difference in monthly payments between option A and option C is $91, but the difference in total interest paid? $6,000. Ollie saw $91 and chose to avoid it. The dealership knew he would. They designed the presentation specifically for that response. But here's the part nobody tells you. That's not even the most expensive thing that happened in that finance office. Before Ollie signed the loan agreement, the finance manager mentioned a few add-ons, casually, almost as an afterthought. An extended warranty, just in case. Gap insurance, in case the car is totaled and you owe more than it's worth. A paint and fabric protection package. We included with certified pre-owned. It's just an additional. Ollie didn't feel pressured. That's important to understand. He felt informed. He felt like someone was looking out for him. He agreed to the extended warranty for $1,800. He agreed to gap insurance for $900. He declined the paint package. He wasn't totally switched off. Now the loan isn't $21,500. It's $24,200 because those add-ons were rolled into the financing, which means at 9.1% APR over 72 months, he's not just paying interest on the car, he's paying interest on the warranty, on the insurance product, on every dollar that got folded into that loan. The $1,800 warranty financed over 72 months at 9.1% APR actually costs him closer to $2,450. The $900 gap policy costs him closer to $1,225. The dealership didn't sell him a warranty, they sold him a financed warranty, which is a completely different product. And this is where it starts to get heavier. 1 week after the purchase, Ollie sits down and actually looks at his full monthly picture for the first time since buying the car. Here's what it looks like. Take-home income, $3,100 a month. Rent, $1,050 a month. Car payment, $432. Car insurance, new car, higher premium, $210, up from $140. Phone, $85. Groceries, $320. Utilities, $95. Subscriptions, $47. Fuel, $130. Total fixed and semi-fixed expenses, $2,369. That leaves Ollie $731 a month for everything else: clothing, social life, unexpected expenses, savings. If something breaks, and things always break, he has $1,800 in savings and $731 of breathing room. That's not nothing, but it's thin. He doesn't feel panic, not yet. He feels mild discomfort, the way you feel when your clothes are a little tight, just enough to make you aware. But here's what's happening underneath the surface that Ollie can't see yet. His old car insurance was $140 a month. His new one is $210. That's $70 more. Over 72 months, that's an additional $5,040 in insurance costs associated with this decision. His fuel costs go up slightly too. The newer car has slightly worse highway mileage under real conditions. That's another $15 a month. Over 72 months, $1,080. We're stacking costs now, and we haven't even talked about depreciation. The car he just bought for $24,500, certified pre-owned, 38,000 miles, will be worth approximately $11,000 to $13,000 in 6 years. The moment he drove it off the lot, it dropped in value by roughly $1,800 in a single afternoon. He still owes $24,200 on it. This is where it gets dangerous. 18 months after the purchase, Ollie's life shifts slightly. His company goes through a restructuring. He's not laid off, but he loses a quarterly performance bonus he'd been counting on. About $1,200 a year, gone. He's still employed, still paying his bills, but the $731 monthly breathing room is now closer to $500 in real terms once you account for inflation and the few small things he's put on a credit card. He has a credit card with a $4,500 limit. It was sitting at about $600 before the car. Now, 14 months in, it's at $1,900. Not because he's been reckless, because he's been absorbing the slow pressure of being slightly overcommitted. Here's the financial reality nobody shows you in a diagram. When you carry a credit card balance at 22% APR, which is the national average for variable rate cards, that $1,900 balance costs you roughly $418 in annual interest if you're making minimum payments. He's now paying $432 a month to the car loan at 9.1%, $38 a month in minimum credit card payments at 22%, $210 a month in insurance, and he's going the wrong direction, slowly, almost invisibly. This is the part that the financial system doesn't warn you about. It's not one catastrophic decision. It's the slow accumulation of small misalignments that compound quietly until one day you look up and wonder how you got here. Ali is not in crisis, but he is no longer building. And not building for a 27-year-old is its own kind of disaster, just one with a 15-year delay. Let's pause Ali's story for a moment. Same city, same salary, same Saturday at the same dealership. Meet Omar. Omar also looked at the 2021 certified pre-owned sedan, but Omar had done one thing differently before walking in. He'd gotten pre-approved for a loan at his credit union. His credit union offered him 6.1% APR on a 48-month loan. He walked in with his own financing already arranged. Omar also didn't want the extended warranty or the gap insurance from the dealership. He'd already checked. His credit union offered its own gap coverage for $250 one time, not rolled into the loan. He put $4,000 down, financed $20,500. At 6.1% APR over 48 months, monthly payment $483. Total interest paid $2,684. His monthly payment is $51 more than Ali's, but his total interest is $6,920 less. And here's the compounding contrast. Because Omar's loan is 48 months instead of 72 months, he's debt-free on the car 24 months earlier. During those 24 extra months, Ali is still writing a $432 check to the lender. Omar has that $432 freed up. If Omar invests that $432 a month into an index fund averaging 8% annual return over those 24 months, he accumulates roughly $11,300. Ali has a car. Omar has a car and $11,300. They started the same day. They bought the same car. One decision, where they got their loan, created an $11,000 gap in 2 years. Now extend that thinking, compound it, because the gap doesn't stop at month 72. By month 48, 4 years in, Omar's car is paid off. He's free. Ali has 24 payments left. He still owes approximately $9,100 on the vehicle, and the car is worth about $14,000 at this point. So Ali is not underwater, but he's not free either. He's still tied to this decision he made in a 20-minute conversation 4 years ago. Meanwhile, something subtle has happened to Ali psychologically. The car payment has become normal. $432 a month just feels like a bill now, the way rent feels like a bill. He's adapted to it. He's restructured his life around it. Behavioral economists call this hedonic adaptation. We adjust to our circumstances, and the thing that felt like a stretch becomes the baseline, which means the pressure doesn't feel like pressure anymore. It just feels like life. But here's the brutal math. Over 6 years, Ali paid $31,104 on this car loan plus the add-ons roughly, plus $5,040 in elevated insurance premiums, plus $1,080 in higher fuel costs, plus $418 a year in credit card interest, about $2,528 over 6 years. Total real cost of this car decision, conservatively, $39,732. For a car he bought at $24,500, and the car is now worth $11,000. He has spent $39,732 to end up with an $11,000 asset. The net cost of this decision in real terms is approximately $28,732. Omar spent $25,184 total, loan plus the one-time gap policy. He has a paid-off car worth $11,000. His net cost, $14,184. Same car, same starting point. $14,548 difference. That's not a rounding error. That's a year's salary for millions of people. In year 5, Ollie's transmission fails on his other car. Wait, he doesn't have another car. He has this one. But the compressor on the AC unit in his apartment gives out in July. Repair cost $1,400. He doesn't have $1,400 liquid. He has $900 in his savings account because the last 18 months have been a slow drain. He puts $500 on the credit card. Now the credit card is at $2,700. He calls about a personal loan to consolidate and gets offered 18.9% APR because his debt-to-income ratio is elevated. The car loan shows up, the credit card shows up. He's not a bad risk, he's never missed a payment, but he's a leveraged risk. He doesn't take personal loans, but the call shakes him. This is the moment in the story where most people start to ask, how did I get here? And the honest answer is one decision at a time.
The car loan wasn't a catastrophe. It was a miscalculation of $91 a month. The add-ons weren't a scam, they were poorly disclosed financial products rolled into a loan at a high rate. The credit card wasn't irresponsible, it was a pressure valve, absorbing the overflow from a budget that was designed with no room for friction. The system didn't lie to Allie, it just never explained the truth. Let's talk about why this keeps happening. Because Allie is not unusual. Allie is the average. In the United States, the average car loan term has been creeping towards 72 months for the last decade. As of recent data, the average monthly car payment on a new vehicle is over $700. For used vehicles, it's over $520. The finance office in a dealership generates, on average, more gross profit per vehicle than the actual car sale itself. Let me say that again. The dealership makes more money financing the car than selling the car. Extended warranties have profit margins of 50 to 70%. Gap insurance products purchased through dealers cost 2 to 4 times with the same coverage costs through a bank or credit union. These are not secrets. They're documented in dealer financial statements and regulatory disclosures, but they're disclosed in dense paperwork on the day of purchase, after you've already emotionally committed to the vehicle. The monthly payment framing isn't accidental. It's a technique with the name. It's called payment packing, and it works because human beings are cognitively wired to evaluate affordability in monthly terms, not total cost terms. When someone asks, "Can I afford this?" they almost universally mean, "Can I make the monthly payment?" Not, "Can I afford the total sum I will pay plus the opportunity cost of that capital, plus the downstream effects on my insurance, credit utilization, and savings rate?" No one thinks that way at the moment. The dealership knows this. The lending structure is designed around this. And the deeper layer, the one that makes this systemic rather than predatory, is that nobody in this transaction is technically lying. The APR is disclosed, the total amount financed is on the contract, the add-on prices are listed. But disclosure and understanding are two completely different things. You can hand someone a map in a language they've never learned and technically say, "I gave you the map." Here's what changes everything. And it's not "don't buy a car" or "save more money." Those aren't answers, those are platitudes. The first thing, get pre-approved before you walk in. Go to a credit union or a bank you trust. Apply for a pre-approval on a car loan. Know your rate. Know your term. Walk into the dealership with your own financing arranged. This does two things. It gives you real negotiating power, and it removes the finance office's primary leverage over you, which is your uncertainty about whether you can get approved and on what terms. The second thing, never negotiate on monthly payment. When a finance manager asks, "What are you looking to pay per month?" that's the moment you say, "I'm more focused on the total purchase price and the total amount I'll pay over the life of the loan." That one sentence reframes the entire negotiation. You're no longer playing on their field. The third thing, evaluate add-ons separately after the fact. If you want gap insurance, call your insurance company and your bank first. In most cases, you can get equivalent coverage for a fraction of the dealership's price, and you won't be paying interest on it for 72 months.
Extended warranties have value for some people in some situations, but they should be evaluated as standalone products, not as something added to a loan at a high interest rate at the most emotionally charged moment of the transaction. The fourth thing, look at the total cost of the loan, not the monthly payment. The number that matters is total amount I will pay from today to the last payment. Write it down, compare it across options, make that your anchor. $432 a month sounds manageable. $31,104 over 6 years sounds serious. They're the same number, but only one of them tells you the truth.
And the fifth thing, the one that sounds small but isn't. Know your floor before you walk in. Know the number below which your budget genuinely cannot go. Not what can I stretch to, what is the actual ceiling and what happens to your life below that ceiling. Ali's floor was roughly $500 a month in free cash flow. A $432 car payment left him with $500 in breathing room, right on the edge. He didn't realize that until a month later. 5 minutes of honest budget math before the purchase would have changed his decision. Let's close with the number that should matter most to anyone in their 20s or 30s. The difference in total cost between Ali's loan and Omar's loan across all the factors we've discussed is roughly $14,500. If Ali had those $14,500 at age 27 and invested them in a broad market index fund averaging 8% annual return, by age 57, 30 years later, that single $14,500 decision would be worth approximately $145,000. Not because he made a brilliant investment, because he didn't make an expensive mistake. This is the compounding cost of a single afternoon. One conversation, one room, one finance manager with a loan product and a monthly payment frame. $145,000. I'm not telling you that Ali ruined his life. He didn't. He'll pay off the loan, he'll move forward. Most people do. But most people also never stop to calculate what the quiet, accumulating cost of average financial decisions looks like across the arc of their lives. Most people look at their bank account and wonder why the number isn't growing faster. And the answer, not the whole answer, but a significant part of it, is a series of $91 monthly payment differentials that were never properly explained. Here's the honest summary of everything I've shown you today. Ali didn't make a stupid decision. He made a decision with incomplete information in an environment designed to keep that information incomplete at a moment of mild pressure when thinking clearly is hardest. That's not a character flaw. That's a human being inside a system. The financial services industry is not your enemy, but it is not your advisor either. A dealership finance office is not there to help you find the best loan. It's there to find the best loan for the dealership. A bank offering you a credit card with $4,500 limit is not investing in your well-being. It's investing in the probability that you'll carry a balance. None of this is secret. All of it is legal. Most of it is invisible. Not because it's hidden, but because the system depends on you never looking at the total number. Your job as someone navigating this, whether you're buying a car, taking a personal loan, financing anything, is to become the person who looks at the total number, who asks, what is the total amount I will pay from today to my last payment? Who says, I'd like to think about the add-ons separately? Who walks in pre-approved so the conversation starts on equal footing? Because you're not going to beat the system by being angrier at it. You beat it by understanding it well enough that it stops working on you. Ali's story isn't over. It never is for any of us. We are all somewhere in a financial decision we made a while ago, living in its consequences, planning the next one. The question is whether the next one is made with the full picture or just the monthly payment. If any part of this story felt familiar to you, if you recognized a decision you've made, or a room you've sat in, or a number you wish you'd looked at more carefully, I'd genuinely like to know where you are in it. Tell me in the comments, are you at the purchase, the squeeze, the long view, or are you the one who walked in pre-approved? Because the next video in this series is going to go deeper into the credit card version of this same system, same psychology, different products, and the numbers are just as uncomfortable. If this feels like something worth understanding, share it with someone who's about to buy a car, not to scare them, just to give them the full picture before they walk in. That's all I've got for today.